Hi, my name is Stephen Kelly, and I'm president of Safety First Financial Planners. This is the first in a series of lessons designed to take you through the features, strengths, and weaknesses of annuities so that you can come to an informed decision as to whether or not they might be right for you. Fixed annuities and life insurance contracts are built on safety. That's the foundation that provides all of the other benefits. Financial experts consider fixed annuities and life insurance, CDs, and treasuries as the safest monetary instruments available. Many regard life insurance products to be the safest of all. Stay tuned and we'll show you why. People often wonder if annuities are FDIC insured, and the answer is no, they are not. But they actually have a better record of depositor protection in the event of company failure than the FDIC could ever have. How can this be? Fixed annuities and life insurance policies are protected by the legal reserve system. Banks can have up to a 9-to-1 ratio of capital to liabilities. Here's what that means. If you deposit $1,000 in a bank, the bank can go to the Federal Reserve and borrow up to $9,000 against that $1,000. Then the bank can lend that money out to personal loans, run businesses, and all of the other commercial lending activities a bank engages in. Where they get in trouble, however, is when they start to get greedy, like what happened in the run-up to 2008, when they started lending to financial markets and investing in derivatives and all kinds of things commercial banks were never supposed to do. Before we knew it, they were buried under mountains of debt that they couldn't pay back, and the whole system came tumbling down. So it's easy to see how banks can easily become over-leveraged, and sometimes in very risky investments like those that led to the recent financial and banking crises of 2008. FDIC insurance is critical for safety and preventing a financial meltdown like happened in the 30s. It's one of the main things that saved us during 2008. Even though the market crashed and lots of banks failed, people knew their deposits were insured. However, as we saw in 2008, even these measures were not enough to prevent another banking catastrophe. And what people don't realize is that if there was ever another run on the banks, like happened in the 30s, the FDIC would never have enough to cover all of the deposits. One of the secrets of the U.S. banking system is that there isn't enough money anywhere to cover all of the deposits. FDIC insurance is more of a psychological illusion to prevent people from running the banks like they did in the 30s. And it worked. But it didn't fix the core problem, which was a flawed banking system. The legal reserve system is entirely different and, as you will see, a much safer and more solvent monetary system. First, legal reserve life insurance companies are legally prohibited from speculating with your money, so they can't put your money into things like derivatives and credit default swaps. Now, it's about here that most people speak up and say, what about AIG? And that's an excellent question. The thing about AIG is that it wasn't their life insurance companies that got them into trouble. It was their parent company, the holding company in the investment division that wanted to corner the market on these risky investments. And when they got into trouble and they wanted to raid the $400 billion in life insurance capitalization to bail themselves out, the legal reserve system prevented them from doing that, as it wasn't their money. It was their policyholders' money, and that is the key lesson behind the legal reserve. It's not their money, it's your money. Unlike banks, markets, or any other financial system, 100% of their investment of your money must by law be invested in the very safest monetary vehicles available. Most goes into investable grade bonds, treasuries, and extremely conservative real estate and other types of commercial developments. The higher their bond portfolio ratings, the higher the ratings of the insurance company itself. Second, life insurance companies are required by law to maintain a greater than 1-to-1 ratio of their capital to their liabilities. If they bring in $1, unlike banks, they cannot lend 9 or 6 or 3 or even $1. The reason is that a large percentage of each premium dollar must go into the policy owner's reserve fund. This is an amount determined by actuaries that is set aside to meet the company's obligations to its policyholders. If an insurance company's reserves fall short and it is unable to correct the problem, the company goes into what's called receivership. The remaining insurance companies in the state legal reserve pool must assume the liabilities and obligations of the insurer. So the next thing that makes life insurance so safe is that legal reserve life insurance companies are members of reinsurance groups. In other words, if you purchase an annuity from Company A has secured agreements from companies B, C, D, and E to cover its liabilities. Each company has from 4 to a dozen or more other companies backing its contracts. In addition, every year all legal reserve life insurance companies undergo thorough examinations from all of the states in which they do business. Most companies are scrutinized not just by one regulatory body, but by as many as 50 if they operate in all 50 states. Companies found not to comply with their reserve requirements have their operations suspended immediately and are prohibited from selling more policies until they have taken corrective action. In the unlikely event that a company is shown to have possible financial weaknesses, one of several avenues is open to it. It can produce additional operating capital. It can sell its business to another life insurance company, or it can merge into another financially stable life insurance company. Legal reserve life insurance companies do not simply close their doors and go out of business, declaring that all policies are null and void. Legal reserve life policyholders enjoy personal security safeguards unknown by any other types of financial industry. And finally, if one company is purchased or merged into another, there is no change whatsoever in the policy benefits or premiums or other terms. Your contract would be just as binding on the new company as it was on the company you originally purchased it from. So the bottom line is relax. In order to lose any money in any fixed life insurance or annuity policy due to company insolvency, all of the following would have to happen. First, your insurance company's very safe bond portfolio would have to fail. Second, the company's surplus fund would have to be completely depleted. Third, the very safe bond portfolios of all reinsurance partners would have to fail. Fourth, the state reserve fund would have to fail. And fifth, there would have to be no company left that could merge with the failing company. This confluence of events has never happened in the nearly 200-year history of the legal reserve system. Legal reserve companies had their strongest showing of strength during the Great Depression of 1929 to 1938, when some 9,000 banks suspended operations while 99% of all life insurance in force continued unaffected. The FDIC is a government agency tasked with ensuring depositors against the over-leveraging that is at the heart of the American banking system and which caused the crash of the 30s and later the 2000s. Many people are not aware that it was not the government that bailed out the banking industry during the Great Depression. It was the U.S. insurance industry. Without it, we never would have pulled out of the Great Depression with our financial system intact. The truth is, the United States insurance system is the most secure financial system on earth. With over $1 trillion in reserve capitalization, it is far more solvent than the U.S. government and the U.S. banking system combined. FDIC insurance was created in response to the bank failures of the 1930s. It did not include the insurance industry because there was no need. It already had the proven safeguards of the legal reserve system in place. Many believe if banks had adhered to this system in the first place, we may never have had a Great Depression and certainly would have avoided the crisis of 2008. So that's it. I hope it helped, and I hope that you have learned something here. If you need any help, please don't hesitate to call us. You can reach us at 855-4-SAFE-INCOME. That's 855-472-3346. Or you can email us at info@truefinancialhealth.com. And of course, you can look at our website at www.truefinancialhealth.com. Thank you for your interest, and I hope you have a great day.